What if I told you inflation doesn't just erode purchasing power? It quietly reshuffles who benefits, and most people don't realize which side they're on. Most people feel it at the grocery store, at the gas pump, in their rent. Everything costs more. The same paycheck stretches less, and it feels like there's nothing you can do about it. But inflation isn't random. It rewards certain behaviors and punishes others. Once I understood that, I stopped thinking about inflation as something happening to me and started thinking about how to position myself within it. This isn't about crypto speculation or chasing trends. It's about practical adjustments that make sense in an inflationary environment, the kinds of shifts that are available to almost anyone, regardless of income. A couple years ago, inflation finally became real for me in a way it hadn't before. I remember sitting in my car after a grocery run, staring at a receipt that was dramatically higher than it had been just months earlier. Same items, same store, different total. At first, I did what most people do, I complained, but eventually I realized frustration wasn't a strategy. If prices were rising, I needed to understand why, and more importantly, who tends to benefit when they do. The first big realization was simple. Inflation tends to transfer wealth away from people who hold idle cash and toward people who hold productive assets. If your money sits in a savings account earning less than inflation, you're slowly losing ground. Not dramatically, not all at once, but consistently. That doesn't mean emptying your emergency fund or making reckless bets. It means being intentional about what your money is doing. For me, that started with tightening my cash buffer. I keep a defined emergency fund, 3 months of expenses in a high-yield savings account. Enough for stability, not excess. Everything beyond that has a job. The goal isn't to beat inflation with a single big move. It's to gradually reduce exposure to assets that lose purchasing power and increase exposure to assets that adjust with inflation over time. One example is real estate exposure, but not in the house flipping landlord sense. Instead, broad real estate investment trusts, or REITs, that own properties with built-in pricing flexibility. Storage facilities, infrastructure, industrial spaces, properties where rent adjusts over time. When prices rise across the economy, many of these assets can reprice as well. It's not guaranteed protection, but historically, certain types of real assets have handled inflation better than cash. Another shift was focusing more intentionally on what I think of as productive companies, businesses that can pass higher costs to customers without collapsing demand. Not every company can do that. Some get squeezed when input costs rise, but others, utilities, consumer staples, essential service providers, often maintain pricing power because people still need what they sell. Owning pieces of companies like that isn't about outsmarting the market. It's about understanding which types of businesses historically navigate inflation more smoothly. Then there's debt, which most people instinctively treat as entirely negative during uncertain times. But inflation affects debt differently depending on structure. Fixed-rate debt, in particular, behaves differently in a rising price environment. If your loan rate is locked and inflation rises, the dollars you repay later are effectively worth less than the dollars you borrowed. That doesn't make debt automatically good. It only makes sense when the underlying asset appreciates or generates returns above the borrowing cost. The math has to be disciplined. But inflation can quietly change the equation. Another adjustment has nothing to do with investing, it's spending strategy. Inflation isn't uniform. Some categories rise faster than others, so I've paid closer attention to where my exposure is highest. Energy costs, for example, can be volatile. Improving home efficiency, insulation, energy-efficient appliances doesn't just lower bills now, it reduces exposure to future price spikes. Buying higher quality goods that last longer is another small but meaningful hedge. Replacing cheap items repeatedly during inflation often ends up costing more than investing in durability upfront. Then there's income. One of the biggest hidden risks during inflation is relying entirely on income that adjusts slowly. Many salaries increase annually, but often not at the same pace as rising costs. That realization pushed me to think more about flexibility in income, not in a flashy multiple income streams way, but in terms of earning capacity that can scale or adjust over time. Side projects, skill development, negotiating compensation. Even small increases compound over time, especially when inflation is persistent. Along the way, I made mistakes. Early on, I overcomplicated things. I chased niche strategies when broad, simple exposure would have been sufficient. Complexity felt productive, but it wasn't necessary. I also hesitated too long at times, waiting for the perfect moment to act. Meanwhile, inflation quietly did what it does. It kept moving. Eventually, I came back to a principle that applies here as much as anywhere else. Time in the market tends to matter more than timing the market, especially when cash is steadily losing purchasing power. Another lesson was taxes. It's easy to focus on nominal returns and forget what you actually keep. Now I evaluate decisions based on after-tax outcomes, not just headline performance. But maybe the most underrated part of navigating inflation is psychological. When prices rise and headlines feel chaotic, it's tempting to react emotionally. Sell everything, hold cash, freeze. But inflation is usually a gradual process, not a sudden cliff. And strategies that work tend to be boring, consistent, and disciplined, not reactive. And that's what makes it dangerous, because gradual erosion doesn't trigger panic. If the value of your money dropped 30% overnight, everyone would respond immediately. But when it happens slowly, 3%, 4%, 5% a year, it feels tolerable. Until you look back 5 years later and realize how much ground was lost. That's why the real risk of inflation isn't volatility, it's complacency. Doing nothing feels safe. But over long stretches of time, doing nothing with your money is actually an active decision, one with consequences. Inflation rewards people who make adjustments early and quietly. It punishes people who wait until the impact becomes obvious. And by then, most of the opportunity has already passed. So where does that leave us now? Inflation in 2026 isn't the extreme shock of the early 2020s, but it's also unlikely to return to the ultra-low levels many people grew accustomed to in the 2010s. That means the default, leave it in savings and forget it approach may quietly erode purchasing power over time. The principles I keep coming back to are simple. Own assets that have historically adjusted with inflation. Avoid excessive idle cash beyond your safety buffer. Build income that has some flexibility. And think long-term, especially when short-term prices feel uncomfortable. Inflation isn't personal. It's structural. It doesn't target individuals, it shifts incentives. The question isn't whether inflation exists, it's whether your financial setup acknowledges it. If this video helped you think about inflation in a more structured way, not just emotionally but strategically, subscribe. I'm continuing to break down practical ways to build resilient finances in changing economic conditions. Because the economy will keep evolving, and the goal isn't to predict every shift, is to position yourself so you're not constantly reacting to them.